AGM first up, sort of key takeouts. The 2017, calendar year 2017, DPS was reaffirmed at 33.5 cents per share. So that puts the stock on a 4.5% yield. How do you compare that to TCL and APA? Well, TCL's on 4.3%, APA's on 4.6%, but APA with a lot lower growth than the other two. Look, I can see that was about an 8% growth from 16 into 17. I can see that 8% growth being sort of continuing into coming years. So that's where you get that nice traffic growth coming through, particularly in the international segment, leveraging into even higher EBITDA growth. And then I'm expecting interest costs to actually decline and then start to head back up. So you get a relatively sort of flattish profile over a 3-year period. So you're leveraging into that sort of 8% type cash flow growth, and they pay out 100% of their cash flow. So that's how you get that sort of 8% growth coming through in the distribution. What was interesting is that they flicked on their DRP. Now, they've done this sort of like once a year for the last 2 or 3 years. And it really is quite a surprise because the balance sheet is just getting stronger and stronger. I mean, they are into credit metrics where, they can get their credit rating upgraded from BBB to BBB+. So they don't really need the additional sort of equity capital coming in. Talk to them about it and they say that it's prudent and investors like the DRP and they've got a bit of a heightened CapEx program at the moment. So, they like to basically get a bit more equity coming in. But, that balance sheet's very strong at the moment. They can fund all this CapEx with debt. Anyway, impact on per share metrics is immaterial, so really not a big deal in the end. The board talked very much about the confidence both in the short term with that traffic growth coming through and in the long term, sort of citing the Western Sydney airport development as being potentially positive in terms of the competitiveness of the Sydney basin for air travel. And personally, look, I've gone from, in terms of the impact of that second airport on Sydney Airport, I've gone from being negative to cautiously optimistic. I mean, this second airport will be quite domestic focused when it first starts up. So that means there could be some low-cost carriers that move their operations across there, freeing up slots for Sydney Airport to sell into the far more valuable international market. And secondly, with a competitor in its basin, it actually the regulatory risk dissipates on the airport. So at the moment, there is this monitoring that goes on, and once every sort of 4 or 5 years, a productivity commission report that comes out looking at just whether the airports are extracting abnormal sized returns. So I think that should go away with that competition in the market. So what that sort of comes into is, I've got more confidence in that long-term outlook. So I've reflected that in a higher terminal value multiple, which flowed through into a 41-cent upgrade to my target. So it takes it to $7.18. Stock is very high quality, obviously very suitable for income-oriented investors and those looking for that exposure to that international travel demand thematic. But at $7.44, where it's trading at the moment, I think that's reflected in the share price, hence the hold rating on the stock still, but still very positive in the long-term outlook.